Good morning, everyone, and welcome to our webinar. My name is Louise Piet. I'm part of the ESG expertise team at WeeFin, an impact fintech dedicated to sustainable finance. During the next 45 minutes, we'll explore the key insights of our 2026 Sustainable Finance Barometer. If you have any questions, don't hesitate to ask them in the chat. So each year, as a mission-driven company and experts in sustainable finance, we aim to publish this barometer to first identify the key ESG practices in this sector, and second, to track the evolution of these sustainable investments. So to do that, we analyzed 60 funds classified under SFDR as Article 8 or 9, and we wanted to cover different geographies. So we studied funds managed by different asset managers, in the US, for example, with BlackRock, or the UK with Schroders, and Europe with LBPIM and Amundi. So to conduct this analysis, we collected more than 200 data points per fund, covering different topics, and we retrieved this information from public documentation such as SFDR annexes and exclusion and engagement policies. So to help us unpack these findings, I'm delighted to be joined by two sustainable finance experts. So Luisa Flores, Head of Responsible Investment Research at OFI AM, and Jean-Baptiste Raphael, Senior Impact and ESG Specialist at Mirova. So our webinar will be structured around the three parts and topics presented in our study. So first, the evolution of ESG ambitions of funds, despite the ESG backlash. Secondly, the impact of SFDR 2.0 on ESG funds. And finally, the analysis of strategy of funds promoting a transition objective. So let's begin with the first section. So our study shows that ambitions of sustainability-linked policies of financial institutions progress between 2024 and 2025, despite the ESG backlash that we all heard of. So here are a few numbers to illustrate this positive evolution. So the proportion of funds that have committed to exclude companies involved in new oil and gas projects has doubled between these 2 years. Also, regarding engagement, the share of funds that have published an engagement report at fund level has also doubled between 2024 and 2025. And finally, we found that biodiversity is more and more included in fund strategy, and the share of funds that were following an exclusion on different stations has actually been multiplied by 5 between 2024 and 2025. So if I start with you, Luisa, are these results consistent with your practices at OFI, and do you plan maybe to develop your ESG investment strategies in the future despite all the regulatory setbacks?
Hello, Louise. Thank you very much for inviting us. So first of all, the trends that you have highlighted in your report are very much aligned with what we are observing and implementing at OFI Invest Asset Management. So despite all this complex environment marked by regulatory uncertainty and geopolitical shifts, we have continued to strengthen sustainability ambitions in our investment practices. So two main drivers have been triggering all these movements. So first of all, the rollout of the third version of the French label was a major trigger for our investment practices. So to comply with this framework, in 2025, we have reinforced exclusion policies, mainly that one related to coal. And then, of course, we have divested the minimum part of fossil fuel that we still have in some equity funds, because we already excluded fossil fuels from all our fixed income strategies, everything, not only sustainable, but all our fixed income strategies. The second driver that has been pushing all these practices was the ESMA guidelines that were enacted in May 2025, and it was tightening our sustainability standards as well. And these guidelines have, these have given more consistency and reliability on ESG claims, and we welcome this kind of changes. So more broadly, so far our range is 65% of our range is aligned with sustainability standards, and for this we have used the IMF, French IMF standards for implementing what we consider ESG standards. And in spite of all this ESG backlash, we're not at all feeling any reduction on their ambitions. Maybe all these clients are less vocal, such as companies are less vocal. However, all their ambitions remain intact.
Yes, like greenwashing.
Yeah, exactly, which is what we call greenwashing. So concerning your last questions on ESG, the future on ESG development strategies, so we are not changing our ambitions. We are reinforcing and maintaining what we have developed for years. And we consider that the debate is not only based on climate and biodiversity, it's larger than that. And that means that we're integrating, for example, physical resilience, technological and regulatory sovereignty. We're also integrating all this geopolitical landscape in our ESG decisions. So beyond this desire that ESG was a tool for doing good, we consider that ESG is more considered as a systemic risk in our portfolios. So for that reason, we see a change on ESG that it was more related on intention to more execution-based ESG. So in our view, this is the political context, and what is happening is not at all impacting on a negative way our ESG ambitions.
Okay, thank you. And so same for you, Jean-Baptiste. Could you share with us your point of view on these results and maybe your roadmap regarding sustainable criteria?
Thank you, Louise, for the invitation. I think that, as you rightly pointed out, there is kind of a paradox between the ESG backlash that we are all experiencing and the increased ESG ambition from asset manager. I think then one of the key factors is regulation, and Lisa mentioned that a bit, the ESMA naming rules, the label ESG as well, the SFDR 2 that is coming in the horizon. I think that there is one other factor that should not be underestimated, is the growing expectation from our clients as well. We have seen many asset owners like big pension funds in the UK or in the Netherlands actually increased the sustainability commitments last year, and also reallocate big mandates over sustainability concern. So I would say that as a result, ESG investing is not shrinking or retreating, actually just becoming more and more selective and challenging. And in this evolving environment, to answer to your second question, I would say that Mirova, we want to remain a leader in sustainability investing. We want to continue to build strategies that are robust, that are evidence-based, that are also impact-driven. And maybe most importantly, we want to stay and to remain at the forefront of innovation. You mentioned biodiversity. Last year, we launched biodiversity funds. And this year, transition finance will be one of our priorities. And I think this is something that we are going to cover today.
Okay, great. Thank you. Also, beyond looking at the ESG policies promoted by the funds, we wanted to take a deeper look at their main investments and the sector allocation that are communicated in their periodic annex. And what we found is that the largest exposures are to finance, industry, and information technology. However, in sectors like finance and tech, climate impacts may still be underestimated because indirect emissions can sometimes be not fully captured. For example, there was a Guardian analysis that estimated that between 2020 and 2022, the actual emissions from the company-owned data centers from Google, Microsoft, Meta, and Apple could have been around 7.6 times higher than the ones officially reported. So these sectors are highly represented in portfolio, but their climate impacts are still being progressively integrated in reporting frameworks. So maybe for both of you, in your views, will sector allocation evolve as the maturity of indirect emission accounting improves, Or maybe also the shareholder engagement actions will maybe be more directed to these sectors. I will let maybe one of you. Yes.
Okay. Yes, I think that in our view, improvement in the maturity and reliability of indirect emissions accounting, especially on Scope 3, will influence sector allocations over time. However, this evolution will be gradual, and engagement will remain a central lever in driving transition. So first of all, so far the current CO2 data on Scope 3 is already modeled. So this is not, we are not using data, real data published by companies, and these models are helping us to smooth this discrepancy between real and reported emissions. However, I'm still totally aligned with your statement. There is an important misinformation on the CO2 emissions of banks and tech. Why all these sectors are overweighted on portfolios, and this is, I would say, this is mainly explained by the part of these sectors on financial benchmarks. This is mainly explaining this decision. However, I think that over time, on a gradual manner, all these sectors may be reallocated. So far within OFI Invest, we are integrating CO2 emissions, for example, in label funds through the principal adverse impacts that we fix to these funds. And CO2 emissions is one of these indicators that we monitor. So this is one manner to, let's say, compensate the overweight of the sector. We are also integrating CO2 emissions when we are calculating climate alignment assessments. This is mainly something that is required by our main clients. So within our mandates, we are integrating this kind of climate alignment assessments. However, Scope 3 is not already very determinant on ESG scores, and that might be one of the reasons that scores are not really giving all this power to Scope 3. So for that reason, engagement will continue to have an important weight in trying to equilibrate the weight of these sectors over time.
Okay, maybe Jean-Baptiste, you want to complete?
Maybe just to start with, at Mirova, we have long been aware that the tech sector has a huge climate impact, and that this is not something that is fully captured by looking at its direct emission. But I think that at the same time, we cannot just ignore a sector that is framing the world we are living in, and also redesigning the energy system, and in particular with the AI and data center trend. So of course, as you mentioned, engagement is absolutely key to address the ESG risk of the tech sector. So just to give you one example, in 2025, we decided to initiate an engagement with NVIDIA on their ESG risk in their supply chain of critical minerals. And at the beginning, the company was not very responsive. So we decided to escalate this engagement, and we co-filed the resolution with a US-based asset owner. And at the end of the day, the company finally took several tangible sustainability commitments in return for the withdrawal of a resolution. So to me, it really shows that even if it's very challenging to engage with, tech giants, it can really work. And one of the key, in my view, to increase the leverage against these tech giants is to collaborate as much as possible with the other stakeholders in the industry, and also to take initiative at sectorial level. I think this is really a key point with the tech sector.
Okay, thank you. So we understand that sustainable ambition then of funds is actually growing despite the ESG backlash. So, but this backlash does not concern actually the SFDR framework, as we know that maybe the future version will be actually more restrictive than the actual one with the requirement of new exclusions. So our analysis of exclusion policies shows that more than 80% of the studied funds would be reclassified as Article 6, mainly due to non-compliance with two exclusions, the 1% threshold revenue linked to coal activities, and with the exclusion of companies involved in oil and gas, new oil and gas projects. So, however, when we take a deeper look at the top investments, we actually found that the exposure to companies that are included in the list of, Urgewald coal, oil and gas lists is quite limited. So we believe at WeeFin that the funds, even if they are not actually for the moment aligned with the new ESG categories requirements, will adapt their policies to meet these SFDR 2.0 requirements, as they've done with maybe, as you say, the ESMA guidelines on fund namings. So maybe, Louisa, are the criteria for you regarding coal exclusion and new fossil fuel projects seem to be the most difficult criteria to be aligned with?
So from our perspective, the SFDR proposal is taking the ESMA guidelines and exclusions in their framework, which is not surprising. And I think that this is being already, part of the work is already done. So concerning the coal exclusion, which is on 1% for coal mining and coal distribution, I would say this is achievable. And of course, if we take into account the Urgewald exclusion list, this is larger in the sense that it's integrating the entire coal value chain.
Yes.
And for example, this is integrating part of the power generators and of course, infrastructure assets. So even if their threshold is higher than 1%, I think that this is covering the entire chain value, which is very positive. And we, in any case, we are relying in this kind of data from Urgewald, with which we consider robust, comprehensive, and from a methodologic perspective, it's sound. So, and of course, the most important thing here is that this exclusion is in line with the scientific scenarios,
yes,
which are reducing coal mainly by 90% in their energy mix. Now, that one that will be a little bit more difficult is that one related to oil and gas.
Yes.
Because from a virtually point of view, excluding companies that are expansion their projects, in practically that represents all the companies in the oil and gas sector. So it's not only those that are enlarging their projects. That means that maybe all companies, oil and gas companies, will be excluded from this Article 9 and Article 7. So at that point, that will be kind of difficult. That means that you will be excluding the whole sector. However, the Category 8, the ESG Basic, seems to keep this exclusion in their portfolio. So that is giving a little bit more flexibility to investors. What is important to determine is how all these geopolitical problems that we are suffering so far will maybe change this proposal. So we will see what will be the final proposal from the Commission.
Okay, thank you. And Jean-Baptiste, in your case, have you also already identified the main changes that will be regarding the work required to be aligned with the SFDR 2.0?
Yes, of course, we have been working on that. First, on the SFDR 2 revision, important to mention that we broadly support the overarching objective of the regulation. We think it will bring more clarity for retail investors to have the new three categories. Regarding the sustainable category, we do not identify any major challenging in their implementation. So, for example, the exclusion criteria for sustainable funds are pretty in line with our internal minimum standard requirements. Regarding the transition fund, we support the implementation of exclusion criteria for the development of new project in fossil fuels. I think it's also important to note that there are two key points that needs to be addressed regarding the assessment of the credibility of climate transition plan, and regarding the engagement criteria as well. And these are really important pieces, in particular for transition fund, in the theory of change of transition fund, which is to help companies in high climate impact sector to achieve emission reduction through the implementation of a climate transition plan. And our role as investors, of course, is through engagement to help them implement these transition plans.
Yes, there is still a need for clarification on these points. So to finish on this section, maybe could you share with us what you intend to do regarding your funds that are currently classified under SFDR Article 8 or 9, and also maybe what is your opinion on how the ecosystem will behave regarding this new SFDR? Jean-Baptiste, maybe you can start this time.
Okay, I can start. So regarding the climate fund, which is the one that is highlighted in your barometer, it will very likely remain a sustainable fund because it's a fund that mostly invests in climate solutions. So climate solutions are defined in the net zero investment framework as companies that mostly sell a product and services with a positive impact on climate mitigation. So that fit very well with the definition and with the objective of a climate fund. Regarding all our other funds, I can say almost certainly that all of them will be categorized across one of the three ESG category. But it's still too early to say because, as I said before,
of course, it's a draft.
Very important detail to set. But what I can also say is that we have a lot of interest for transition funds. I think that they are very relevant both from a pure financial perspective because they allow more sector diversification. Because the essence of transition fund is to be exposed to high climate impact sectors and to invest in companies that are in hard to abate emission sector, as we say. And crucially, and I think this is very important to have that in mind, transition funds are also very interesting from a pure impact perspective because they allow to bring additionality through, as I said before, allowing companies to decarbonize their own processes and activity because they are implemented a climate transition plan and investors encourage them to do so.
Okay. And maybe from you?
Yes, so on our side, we are not anticipating a big or a radical change after the SFDR implementation. And why? Mainly because we have a very limited share of Article 9 in our range. So concerning Article 9, we're not seeing any major changes. On Article, let's say most of our range is Article 8. And as I mentioned earlier, we are mainly aligned with the IMF categories 1 or 2. So that means that either we are reducing part of the 20% of the investment universe, or we are requiring a better ESG score compared to that one of the benchmarks. So that means that if Article 8 will have one of both characteristics, we are already aligned with that one. So we are not seeing any major changes on our Article 8. There where we see that will be maybe new appetite for product development is on the transition category, as you mentioned, Jean-Baptiste. I think that, so clients are interested because there's diversification, as you mentioned, because in terms of impact is also something that they would like to use. However, I think that we have to be very, very attentive on the way they define credible transition plans. As we all know, the transition plans have been canceled, erased from the CSFD. So on one side, the Commission is pushing investors for creating these kind of categories. And on the other side, companies are not anymore constrained to produce any transition plans. So for that reason, I think that that will be a very challenging part for us. And I think that the second challenge that we have to be very attentive is on the ESG basics. I think that maybe everybody will go straight to the ESG basics as far as there is no exclusion of oil and gas.
Yes.
So let's see. And
Yeah.
I think that maybe the last trend that I would say is that given all what is happening so far, there will be more and more Article 6, which in the past used to be the elephant in the room, and I think that that will not be anymore the case.
Okay. Okay, thank you. So as we just highlighted, then we are really increasingly hearing about the transition and portfolio decarbonization. As you said, climate risks are becoming more real every day. There was a recent storm in the south of France that illustrate that, as Morningstar had just estimated that the insured losses could surpass 3 billion euros. So this is why we wanted to focus also on transition, and we collected data from 18 funds that had a quantified transition objective, so either a CO2 emission reduction target or a temperature alignment objective. And our analysis revealed that 33% of them have a mature engagement policy, and 40% of them have a mature thermal coal exclusion policy, creating a 10-point gap between compared to the funds without this quantified transition objective. To note that the engagement and coal policy of Mirova and OFI that we analyzed were considered mature according to our methodology. So maybe Jean-Baptiste, the fund that we studied from Mirova was promoting a temperature alignment objective. So do you believe that funds that are promoting transition should actually define a quantified objective, as we just highlighted, to make their objective more credible?
Thank you for this question. So, you know that at Mirova we have been communicated on temperature alignment for 10 years, and I think we were pretty innovative at that time. To be honest, now we are working on different ways to better highlight the different levels of impact of our different sustainability strategies and portfolio. And to this end, we are adopting the NZIF framework, so Net Zero Investment Framework, that was developed by the IIGCC. And the idea here is to develop a portfolio into 3 categories of companies. The first category being climate solution, which I developed earlier. The second category will be for companies that are not climate solution, but that have implemented a credible climate transition plan. And the third category will be for companies that are neither climate solution, not a company having a climate transition plan, and which therefore are priorities for active engagement. Yes. And the idea here will be, according to the different strategies of the fund and according to the way we want to highlight the impact of our strategy, will be to set, for example, objectives in terms of share of climate solution, or objective in terms of share of companies with a credible transition plan, and most importantly, maybe objectives in terms of share of priority companies under active engagement. Because the thing with a single data point, such as temperature alignment, is that it does not really take into consideration the impact we can reach through active engagements, for example. So this is something that is maybe a bit more complex than having a single data point, but we are really convinced that it brings a lot of value to better reflect, again, the different levels of impact for our different categories of ESG funds.
Okay, so maybe more complete. Okay, and also we believe at WeeFin that promoting a transition objective should, the funds that promote that kind of objective should have a credible engagement strategy if they use this strategy to achieve their targets. So, Luisa, are you aligned maybe with that? And also, according to you, what makes an engagement policy mature?
Yes, I fully agree with your statement. As Jean-Baptiste mentioned, every transition objective needs to be supported by a credible engagement strategy. And that means engaging with very specific sectors. This is not about engagement with everyone on everything.
Yeah.
So that's why it's important to define strategic priorities for sectors. So for example, those that are in high impact emitting sectors, or for example, when we see a misalignment on CapEx, or for example, if they have an important influence in the economy and they haven't defined a credible transition strategy. So beyond that, beyond identifying the sectors, it's also important to identify quantifiable time-bound objectives. That means that what is in which indicator we're going to pilot over time, in what time frame, and what progress will be measured. This is very important. Next, we need to define escalation steps, because if we are not defining what is happening, if the company is not at all contributing, I think that may be perceived as not stringent enough. So it's important to define either if we are repeating this engagement or we are escalating through collaborative engagements or through filing new resolutions, even if the moment maybe is not the best time to do that.
Yeah.
Voting against directors or voting against routine resolutions is also another way of doing escalation. And ultimately, divestment could be also an important way of signaling to the company that something is not going on the right manner. And I think that in the end, also what is important to support engagement is reporting. That means how you're communicating all the steps to your clients, or the way that you're supporting for doing real impacts on the real economy.
Okay, thank you. All these criteria are actually integrated in our maturity level methodology. So another finding from our analysis is that funds with a transition objective have actually a lower weighted average carbon intensity than the ones without this transition objective. But if we take again a closer look at the top investment that are communicating in the periodic annex, the difference actually disappears. So, for example, the share having a net zero SBTi target doesn't really stand out. Also, the ACT scores are not really better. And finally, the taxonomy-aligned CapEx, as you talked about, are not higher either. So, in summary, these funds having a quantified transition objective have performed better on a carbon intensity level, but the investment choices are not really do not really reflect the transition objective when we look at other key metrics than carbon intensity. So maybe, Jean-Baptiste, what is your view on these results? And can you tell us if these indicators are not maybe usually included in transition methodology and in the management on transition fund?
So to be honest, I'm not really surprised by this result, because as of today, there are not really binding criteria for defining transition fund. The criteria that has been set, for example, by the ESMA naming rule, they do not relate at all to fossil fuels. So this is why you can see funds that are labeled as transition fund that are actually not exposed at all to high climate impact sector, which is at odds with the essence of transition fund. And on the other end, you also have funds that are labeled as transition fund that include companies that do not have at all a credible climate transition plan and that are not even in the process of implementing a climate transition plan. The good news story is that things are probably moving in the right direction. Hopefully, SFDR 2 will help better frame and define transition funds. And I think there is also one other factor to consider, is that there are transition frameworks that are also more and more adopted by market players. As I said before, we at Mirova, we adopted the NZIF framework, and I think it will help better, let's say, set the boundaries of transition funds. It will help increase the comparability between the different funds, and every player in the market will relate to the let's say, relevant categories for implementing and comparing transition funds. the emission reduction targets, the decarbonization plan, the decarbonization level, the capital allocation, the emission performance, etc., etc.
Okay, thank you. And Luisa, on your side, are these results a surprise for you?
No, I think that I fully align with what Batista has explained. I think that so far, in a very simple manner, CO2 emissions has been the main driver for defining this. And I think that the CTB and PAB benchmark, when they were defined, they were integrating reduction of CO2 emissions by 7% on a yearly basis. And this was mainly used as a methodology when you were saying, I have a climate fund. So what is important here in your report is that is not only the only indicator that we needed in the future, that we need to go further with CapEx, with solutions, with transition, even with all the governance within the company, how the board of directors are so far prepared to manage these risks. As far as you mentioned, physical risks, climate physical risks are becoming more and more important. So even if companies are not aware or sensitive to these issues, physical risks are becoming a key driver. So yeah, fully aligned with that statement.
And also, so we know that assessing a company level of transition, as you mentioned, usually required in-depth qualitative analysis. And at Mirova and OFI, you've both developed and constructed methodology to assess these levels of maturity. So maybe to conclude this webinar, I would like to ask you, based on your experience, what key advice would you give, and what are the main changes that you have identified for financial institutions that want to build this kind of methodology?
I think that a key challenge to me is to assess the credibility of a climate transition plan. It's true that we have access to more and more data and frameworks, but in the end, it remains a very qualitative exercise that requires a lot of sector knowledge, a lot of expertise, because you have to assess the credibility of a climate transition plan, but you also need, to assess the relevance of the decarbonization level of the company. You need to assess the coherence of the capital allocation. So this is something that really need a lot of added value from analysts. And this is also something which is very important as part of the label ESR that we discussed before, and probably in the future as part of the SFDR2 transition category. And from a key advice, I would say to allocate resources for stewardship activities in general. So by stewardship activity, I think of engagement at company level, engagement at sector level, and also policy engagement. This is something that is really time-consuming. This is something that implies a lot of human interaction, because you need to talk with executive, experts, policymakers. So this is clearly something that AI cannot replicate. And at the same time, this is something which is very essential because, again, engagement and stewardship activity is really key to leverage additionality in the listed equity sphere in general and in transition finance in particular.
Okay, thank you. And Luisa, maybe on your side?
Yes, maybe what is difficult so far is that we are seeing all these climate risks increasing in very particular areas. In the past, we have seen, for example, that insurance companies in California has closed their activities because this is not anymore economically driven. So that means that from a very economic perspective, climate risks are having financial impacts and economic impacts, not only for companies, but also for investors. In the US, for example, 60% of climate disasters occur in the US, but in the same time, we're seeing that the US is going on the opposite direction. However, last year, there was a report published by one commission from the Senate indicating that as far as climate risks are increasing, insurance companies are not providing insurance. And when you're not providing insurance, the value of these either companies or houses are going down. And when all this is going down, they were awareing, saying that might produce any financial risks. So my message is, why I'm explaining all this is because more and more all these physical risks are being translated into the economy. So this is not only what I was mentioning at the very beginning. We are not only talking about intention-based ESG, but more about implementation. And my advice for all these people that might be interested and don't know how to start, I would also say, so stewardship is important, but also integrating this into macroeconomic perspectives.
Okay.
And I think that we've been working on ESG on a very micro perspective, so on companies base. But here, that will be interesting to see what will happen in 10 years, what will happen with the rates, with growth, with inflation in 10 years if we continue having these stress tests, these climate scenarios. And that will change the way maybe we're allocating money in our portfolios. If we see that interest rates will be higher, that maybe inflation will be higher because maybe with all these climate difficulties, the economy will be in a difficult manner. So that will have an important influence on the allocation of portfolios. So that will be my advice, to start integrating all this in macroeconomic perspective over 10 years. And that will have a different impact in investment portfolios.
Okay, great. Thank you very much. I don't know if you want to add anything, but otherwise, thank you. And thank you all for listening to our webinar for today. Don't hesitate to download our 2026 Sustainable Finance Barometer for free, and have a good day.